The year is 2035. You wake up, check your phone, and something feels off. Gas is $11 a gallon. Rent just doubled. Again, your salary? Still the same. The economy didn't crash overnight. Nobody declared war on your bank account. But somewhere between breakfast and your commute, the world's most powerful currency quietly started dying. This isn't a collapse you hear. It's one you wake up inside. Welcome to the death of the US dollar, a slow-motion unraveling that started decades ago, hidden inside a $34 trillion debt machine most people never bothered to understand. Here's what you need to know. For over 70 years, the dollar has been more than money. It's the operating system of global trade. Oil gets priced in it. Debt gets issued in it. Countries hoard it like oxygen. When a factory in Malaysia orders steel from Germany, the invoice comes in dollars, not ringgit, not euros. When Egypt needs to import wheat, it doesn't matter what currency they use at home. The bill is in dollars. Let me show you why that matters. Imagine you run a small import company in Lagos, Nigeria. You need to buy $50,000 worth of machinery from China. But you don't have dollars, you have naira. So you go to your local bank, convert your naira into dollars at whatever rate they'll give you, wire the payment to Shanghai, and hope the exchange rate doesn't move too much before the deal clears. Now imagine the dollar starts losing value. Not dramatically, just steadily. Suddenly, you need more naira to buy the same amount of dollars. Your costs go up. Your margins shrink. You didn't do anything wrong. The currency you need just got more expensive to hold. Multiply that by every business, every government, every central bank on earth that needs dollars to function. That's the invisible tax the world pays for using someone else's money. And for decades, it worked. America printed. The world accepted. It was the deal. But here's the dark irony. The system that made the dollar essential is the same system now tearing it apart. Because to keep the machine running, America had to borrow. And borrow. And borrow. $34 trillion in debt, and counting. That's not just a big number. It's a treadmill that speeds up. Every year, the US government pays interest on that debt. And every year, it borrows more just to cover the interest. It's a debt snowball rolling downhill, gathering mass, picking up speed, and there's no visible bottom. Math doesn't care about feelings. When you owe more than you earn, when your creditors start asking questions, when trust begins to crack, reserve currency privilege doesn't save you. It just buys you time. And that time, it's running out. Let's talk about the first fatal wound. The debt itself. $34 trillion sounds abstract until you realize what it actually means. It's not money the government spent and forgot about. It's money it has to pay back, with interest. And here's where the math gets ugly. In 2024, the US government collected roughly $4.5 trillion in tax revenue. Sounds like a lot, right? But it spent over $6 trillion. That's a $1.5 trillion gap. Every single year. So what does Washington do? It borrows to cover the shortfall. It issues treasury bonds, IOUs that promise to pay back the money plus interest at a later date. Investors buy them. Foreign governments buy them. Pension funds buy them. Why? Because for decades, US debt was considered the safest bet on earth. But here's the trap. When you borrow $1.5 trillion this year, next year you don't just owe $1.5 trillion. You owe $1.5 trillion plus interest. And you still have the same spending gap. So you borrow again, this time more. It's a debt snowball, and it's rolling downhill, fast. Let me give you a simple example. Imagine you earn $4,500 a month, but your expenses are $6,000. You're short $1,500 every month. So you put it on a credit card. Month 1, you owe $1,500. Month 2, you owe $3,000, plus interest on the first $1,500. Month 3, you owe $4,500, plus compounding interest. At some point, you're not borrowing to live anymore. You're borrowing just to pay the interest on what you already owe. That's not a budget. That's a countdown. Now scale that up to a country with $34 trillion in debt. In recent years, the US has been paying somewhere around $600 to $900 billion per year just in interest. Not roads, not schools, not defense, just interest. And as rates go up, so does that bill. Here's the dark irony. The Federal Reserve, the institution that controls interest rates, has two choices. Keep rates low to make the debt affordable, or raise them to fight inflation. If they keep rates low, Inflation eats your savings. If they raise rates, the government's interest payments explode. You cannot make this up. They're trapped between two fires, and both of them burn the same people. But that's not the worst part. The real danger isn't the debt itself. It's what happens when the world starts asking, can you actually pay this back? Because the moment that question gets loud enough, the confidence game ends. And when confidence breaks, currencies don't decline, they collapse. So here's what you need to understand. The debt snowball isn't just rolling, it's accelerating. And the people holding the IOUs, they're starting to notice. Here's the second fatal wound. The printer itself. When a country can't pay its bills, it has two options: default or print. Most countries can't print. If Argentina runs out of money, it can't just create more pesos and expect the world to accept them. The peso isn't global reserve currency. But the dollar? Different story. The US has a superpower most nations don't. It can print dollars, and for decades, the world had no choice but to take them. Oil priced in dollars, debt issued in dollars, reserves held in dollars. The system required it. But here's where it gets dangerous. Printing money doesn't create wealth. It dilutes it. Think of it like this. You're at a poker table with $1,000 in chips. Suddenly, the dealer hands out another $1,000 in chips to everyone. Did you get richer? No. You just have twice as many chips chasing the same pot. That's inflation. More money, same goods, higher prices. And when a government prints to cover its debts, it's not just inflating away the problem. It's inflating away trust. Let me show you what happened. In 2008, the financial system nearly collapsed. The Federal Reserve responded by printing trillions of dollars. Quantitative easing, they called it. The idea was simple: flood the system with liquidity, keep banks alive, prevent a depression. It worked. Sort of. The economy didn't collapse, but the money supply exploded. And every dollar printed was a quiet tax on every dollar already in circulation. Then came 2020. Pandemic, lockdowns, economic free fall. The Fed printed again, this time faster and bigger. Trillions more. Congress sent checks. The Fed bought bonds. Money poured into the system like water through a broken dam. And for a while, it felt fine. Stock market up, housing up, everything up. But that's not the worst part. Inflation didn't show up right away. It waited. By 2021, prices started climbing. By 2022, inflation hit levels not seen in 40 years. Gas, groceries, rent, everything got expensive fast. And people started asking the uncomfortable question, what is this money actually worth? Here's the thing about reserve currencies. They survive on trust. Trust that the issuer won't abuse the privilege. Trust that a dollar today will still buy something tomorrow. But when you print trillions, when you flood the system to patch over problems you refuse to fix, you're not managing an economy. You're running a confidence game. And confidence? It's not a fact. It's a feeling. The moment people feel the money losing value faster than they can earn it, the game shifts. Let that sink in. You can have the world's reserve currency. You can print as much as you want. But if no one believes it holds value, it doesn't. And here's the dark irony. The very tool that kept the system alive is now the thing killing it. Because every time the Fed prints, it's making a bet. A bet that the world will keep accepting dollars. A bet that inflation stays controlled. A bet that trust doesn't break. So far, the bet has held. But the margin for error? It's shrinking. Here's the third fatal wound. The weapon. For decades, the dollar wasn't just money. It was leverage. If you wanted to trade globally, you needed dollars. If you wanted to borrow internationally, you issued dollar-denominated debt. If you wanted to store wealth safely, you bought US treasuries. The system gave America something no empire ever had before: financial control without occupation. But here's where it gets messy. America didn't just manage the system. It weaponized it. Let me show you how. When a country steps out of line, politically, militarily, economically, the US has a tool more powerful than missiles. Sanctions. Cut a country off from the dollar system, and you cut them off from the world. No access to SWIFT, the global payment messaging system. No ability to settle trade in dollars. No way to access international markets. It's economic strangulation. Clean, quiet, devastating. Russia found out in 2014 after Crimea. Iran's been living it for years. Venezuela, North Korea, the list grows. And for a while, it worked. Sanctions were a geopolitical superweapon, punishment without invasion. But here's the thing about weapons. Use them too often, and people start building defenses. When you freeze a country's dollar reserves, you're not just punishing that country. You're resending a message to every other country watching. Your dollars aren't really yours. Let that sink in. If the US can freeze Russia's foreign reserves, hundreds of billions of dollars, with the stroke of a pen, what's stopping them from doing it to you? Suddenly, holding dollars isn't just an economic decision. It's a political risk. And this is where it gets dangerous. Countries started diversifying. Not loudly, not all at once, but steadily. China started pushing the yuan for trade settlement. Russia and India began trading in rubles and rupees. Saudi Arabia, yes, Saudi Arabia, started discussing oil sales in currencies other than dollars. You cannot make this up. The very countries that built their wealth on the dollar system are now quietly looking for exits. Here's the dark irony. The weapon that made America untouchable is now the thing making the dollar replaceable. Because once you show the world that dollars can be seized, frozen, or weaponized at will, you've broken the one thing reserve currencies need most. Neutrality. Money is supposed to be apolitical, a medium of exchange, a store of value, not a tool for foreign policy. But the US turned it into one. And now the world is responding, not with anger, but with alternatives. The dollar didn't lose its dominance because it stopped being useful. It's losing it because it stopped being trustworthy. And trust? Once lost, it doesn't come back. Here's the fourth fatal wound. The buyers. Remember those treasury bonds we talked about? The IOUs America sells to cover its debt? For decades, foreign countries lined up to buy them. China, Japan, Saudi Arabia, the Gulf states. Why? Because treasuries were safe, liquid, and paid in the world's reserve currency. You could park hundreds of billions there and sleep well at night. But something's changed. The buyers are backing away. Not all at once, not dramatically, but steadily. And that's more dangerous than a sudden exit. Let me show you the numbers. In the early 2010s, foreign holders owned roughly 50% of US government debt. By recent years, that number's been dropping. China, once the largest foreign holder, has been selling. Not because China doesn't need reserves, because it doesn't trust the system anymore. And this is where it gets dangerous. When foreign buyers step back, someone else has to fill the gap. So who buys the bonds? The Federal Reserve. Yes, the same institution that prints the money is now buying the debt. It's a loop, a closed circle. The left hand borrows from the right hand and calls it financing. Let that sink in. You're not funding your government with foreign savings anymore. You're funding it with your own printing press. That's not strength. That's desperation dressed up as policy. But here's the thing. When you lose foreign buyers, you lose more than just funding. You lose discipline. Foreign creditors ask hard questions. Can you pay this back? What's your plan to close the deficit? Why should we keep lending? When you're borrowing from yourself, those questions disappear. There's no one left to say no. And without external pressure, the borrowing accelerates. The spending grows. The debt compounds. Here's the dark irony. The very people who funded America's rise are now quietly walking away. And America's response? Print more. Borrow more. Pretend it's sustainable. But math doesn't care about feelings. Every bond that gets bought by the Fed instead of a foreign government is another step toward a closed loop. And closed loops don't end well. They end in currency collapse or runaway inflation. Sometimes both. So here's a question for you, genuinely. If you had to choose, hold dollars for safety or diversify away, what would you do? Think about it. Because the foreign buyers already have. Here's the fifth fatal wound. The alternatives. For 70 years, there was no real choice. If you wanted to trade, you used dollars. If you wanted stability, you held dollars. The system had a monopoly, not because it was perfect, but because there was nothing else. But monopolies don't last forever, especially when the monopolist starts acting reckless. Around the world, quietly, something new is being built. Not a replacement, not yet, but the scaffolding for one. China launched the digital yuan. Russia and China are settling trade in their own currencies. The BRICS nations, Brazil, Russia, India, China, South Africa, are discussing a shared currency for cross-border payments. Even Europe, America's closest ally, has been pushing to strengthen the euro as an alternative reserve asset. None of this is loud. None of this is sudden. But it's happening. And this is where it gets dangerous. You don't need to kill the dollar to weaken it. You just need to give the world options. Think of it like this. Imagine you live in a town with one grocery store. The owner raises prices every year. The quality drops. The service gets worse. But you keep shopping there, because where else are you going to go? Then one day, a second store opens. Not perfect, not cheaper, but it's there. You don't switch overnight, but you start shopping around. You split your purchases. You hedge your bets. That's what's happening to the dollar right now. Countries aren't abandoning it. They're reducing their dependence on it. Saudi Arabia, the anchor of the petrodollar system, has been in talks with China to accept yuan for oil. That sentence alone should terrify anyone paying attention. Because if oil stops being priced exclusively in dollars, the entire foundation of dollar dominance cracks. Here's the thing about reserve currencies. They don't collapse in one day. They bleed in public, then break in private. And right now, the bleeding has started. Central banks are diversifying their reserves into gold, euros, yuan, anything that isn't purely dollar dependent. Trade agreements are being rewritten to bypass dollar settlement. The world isn't rejecting the dollar out of spite. It's protecting itself from risk. And the biggest risk? Trusting a system run by someone who keeps changing the rules. So here's the dark irony. America spent 70 years building a system where the world needed the dollar. And now it's spending every year giving the world reasons to leave it. The multipolar drift isn't a conspiracy. It's a rational response to an unstable monopoly. And once that drift becomes a trend, it's almost impossible to reverse. Here's the sixth fatal wound, the one that ties them all together: confidence. Every currency in history has rested on the same invisible foundation. Not gold, not armies, not even GDP. Trust. Trust that tomorrow, the money in your hand will still buy something. Trust that the issuer won't debase it. Trust that the system is stable, predictable, managed. Reserve currencies live or die on that trust. And right now, that trust is cracking. Let me show you what happens when the cracks widen. It starts slow. A headline here. A policy shift there. Inflation ticks up. Debt grows. Foreign buyers pull back. Each event, taken alone, feels manageable. But stack them together, and something shifts. People start asking questions. Not out loud, not in panic, but quietly, in boardrooms and central banks and trading floors. How long can this last? What happens when the debt becomes unpayable? What if the dollar isn't safe anymore? And then the market asked a simple question. What is this actually worth? That's the moment everything changes. Because once doubt enters the system, it spreads. A pension fund in Tokyo recalculates its dollar exposure. A sovereign wealth fund in Abu Dhabi shifts 5% of reserves into gold. A central bank in Singapore quietly sells treasuries and buys euros. None of it is dramatic. None of it makes headlines. But the trap snaps shut. Not with a bang. With a slow, grinding inevitability. Here's what people don't understand about currency collapses. They don't happen because the money disappears. They happen because people stop believing in it. You can have the same dollars in your account, the same GDP, the same military, but if the world stops trusting the value, none of it matters. Let that sink in. And here's the thing about confidence. It's not rational. It's emotional. It's a feeling that builds over decades and breaks in days. You can't rebuild it with press releases. You can't restore it with interest rate hikes. Once lost, trust takes generations to recover, if it ever does. So here's where we are. The debt is unpayable. The printer is running. The weapon backfired. The buyers walked away. The alternatives are rising. And now, the one thing holding the system together, confidence, is starting to fracture. This isn't speculation. This is the visible arc of every reserve currency that came before. The British pound, the Dutch guilder, the Spanish dollar. All of them dominated. All of them seemed eternal. And all of them fell, not because they were invaded, but because the world stopped believing. The US dollar is walking the same path. Slower, maybe. Louder, definitely. But the direction is clear. And the endgame? It's not far off. So here we are. The debt is a snowball. The printer's reputation is shot. The weapon backfired. The buyers left. The alternatives are real. And confidence, the invisible glue holding it all together, is starting to dissolve. The question isn't whether the dollar will fall. The question is how. There are two futures ahead. Both are possible. Neither is pretty. Future one, the reset. The US government, facing an impossible debt load, decides to act. Not out of virtue, out of necessity. They restructure. They default, politely, through inflation or debt forgiveness or some creative accounting trick that sounds better than we see and pay. the dollar loses value. Fast. Imports get expensive. Savings evaporate. The standard of living drops. But the system survives, barely. A new currency arrangement emerges. Maybe digital. Maybe backed by a basket of assets. The dollar becomes one option among many. America remains powerful, but no longer exceptional. Future 2, the drift. Nothing dramatic happens. No single collapse. No declaration of default. Just a slow, grinding erosion. Inflation stays elevated. Not catastrophic, just persistent. The debt grows. The Fed keeps printing. Foreign holders keep quietly exiting. Year by year, the dollar's share of global reserves shrinks. Trade deals bypass it. Oil gets priced in multiple currencies. And one day, maybe 20 years from now, someone looks back and realizes the dollar isn't the world's reserve currency anymore. It just faded. No ceremony, no announcement, just irrelevance arrived slowly. Both futures share one truth. Math doesn't care about feelings. You can't print your way out of insolvency. You can't weaponize trust and expect it to remain. You can't borrow forever and call it a strategy. Reserve currencies don't die in one day. They bleed in public, then break in private. And the US dollar? It's already bleeding. So what does this mean for you? If you're holding dollars, you're holding risk. Not immediate, not catastrophic yet, but the clock is ticking. Diversify. Hold assets that aren't denominated in any single currency. Think about gold, real estate, skills, networks, things that hold value when paper doesn't. And here's the dark irony one last time. The people who see this coming won't be the ones hurt worst. It's the people who trusted the system, who believed the story, who kept their savings in dollars because it's always been safe. They re the ones who wake up inside the collapse. You cannot make this up. The world's most powerful currency, undone not by war, not by invasion, but by its own government's refusal to live within its means. So here's your takeaway. The US dollar is dying. Not tomorrow, not next year, but the trajectory is set. And the smartest move you can make? Stop pretending it isn't happening. Thanks for watching. If this made you think or uncomfortable, hit that like button. Subscribe if you want more uncomfortable truths. And if you think I'm wrong, great. Leave a comment. Let's talk about it. Because the one thing worse than knowing the dollar is dying is pretending it's immortal.